So welcome back everybody, and now let's walk through the balance sheet of the Industrial Holding Corporation. Here you can see there are only 2 years available concerning the financial numbers of the holding. On the left hand side you can see the assets of the company. On the right hand side you can see the liabilities and the equity of the company. What the assets are basically the part of the corporation that is owned by the firm. These can be like, for example, gross machinery or real estate or cash. And on the right hand side, you can see the parts, mainly the equity deal and the liabilities, that show that how the certain assets on the left hand side are financed. So if they're financed from equity, this means that for example, the current assets are financed from equity. Then in this case, it says that the liquid assets are the company's own liquid assets, and liabilities are substantial. And for example, if the, I don't know, net machinery and equipment is financed from liabilities, then it's actually its financing source is an external source such as bank loan or bond issuance. Now let's go a little bit deeper into the details of the corporation. Here, let's start with the current assets. We can call them liquid assets. And this number here, the 96 million US dollars, is added up from the upcoming four elements for this AR or accounts receivables. Well, basically, those are those accounts that are still not paid by the stakeholders of the company. It can be like, I know the company sold some products and the client still didn't pay them and we are waiting for them. If we say that we have inventories here, it's only 5 million compared to the total asset side. It's very small, actually, which is showing that we are dealing with an industrial holding corporation. It does not have many inventories, and it has a kind of good and huge amount of cash, which is very good because if there are any short-term obligations from the client side, then the holding corporation will be able to fulfill them. Term stocks for trading mean that a company invested into some stocks, and probably they are not holding them for investment purpose, which means that they are not holding them for more than a year. And these cases have to be evaluated as a short-term asset. And I wrote them that it's for trading, which means that probably they don't have any further idea concerning the equities they bought, what to do with them. They are just holding them to make some financial return for the company. But it's not a substantial equity for this corporation. So you can see that in the next year they have sold everything. And if we go further, we can see that we have a huge number in both years concerning the assets of the company. It's the fixed assets part. Obviously, it's going to be huge because it's an industrial company, and for its operations, heavy equipment, industrial equipment, and other stuff is used. And here you can see in the first part that we have gross machinery and equipment and amortization below that, and then net machinery and equipment. So these three throws linked together. We are only interested in the last one because in the balance sheet, always the net result gets into. So the current amortization rate must be subtracted from the gross machinery and equipment, and these two parts, so the gross machinery and the equipment and the amortization, is actually almost never in the balance sheet, but I just wrote it here because I think it's very good for you to see and understand the whole system. If we go a little bit further, then you can see that we have also a huge amount or substantial amount of real estate. It's 44 million in both years. So actually the value of it didn't change. This can be, as I have mentioned it earlier, like, I don't know, the real estate, like the office park that is needed for the operations for the company, some factories or any production units that can be considered real estate. Obviously, it is also a huge and substantial part of the company's balance sheet. Their long-term assets are not owned by the company, and there are only or a kind of a high level of long-term financial assets. Financial asset is actually any asset that the company bought but holds for more than a year, and then it had to be evaluated as a long-term financial asset. Obviously, it can be like a state bond that is paying stable cash flows for the company. And in this case, the company or the investor, which is the industrial holding corporations this year, is not having any short-term, I don't know, financial income making plans. Rather, the company is actually waiting for the stable and long-term cash flows for of the bond. And if you go down, you can see there the equity income and the expense in any cases is zero. And how to define it? Well, actually, equity income is actually a claim from the company side, which means that they have an income which is actually belonging to the certain year. So this zero is belonging to this year, to the zero, but it was not paid. So it's still kind of a claim from the client side. And we add up the key factors like current assets, fixed assets, net your income. We can get the total assets for the company. Here, for the next year, you can see that the equity did not really change. Equity is a number that we sum up from the retained earning, from the capital reserves, and from the equity capital. The equity capital is its key part, is actually the money that was paid into the corporations by the investors. So it did not change throughout the 2 years. And the retained earnings are actually those part of the net income, which was computed here, that actually is not paid out to the clients from dividend. And actually, this means that money that was produced from by the corporation, then it stays in the corporation. So it's the own money of the company. In this case, it's not that huge. So if you derive like 28 by the liabilities, in this case, it's 1/6, so it's not that high. But as we can see, the current assets are substantial concerning the company, so it's not going to be a huge problem, but we will see in it later section. And regarding liabilities, we have a huge indebtedness. For example, it's 52 from the first year. It's even higher, 252, 45, sorry, the client's balance sheet, so it's huge. But as long as it's operating, as long as this company is operating well, then in this case, we have nothing to do with that. And let's see now how liabilities look like. So we just simply add up the current ones with the long-term ones. The current liabilities consist of short-term loans, so like loans with a shorter tenure. So actually, short-term loans, short-term credits, and accounts payable. Let's start out now what accounts payable mean. Accounts payable is actually any account that has arrived to the client or to the industrial holding corporation and was not paid yet. Short-term credits and loans are kind of the same thing. So they both belong to the client. And these loans are having a shorter tenure, so 1 year or 2 years. So these are kind of the current obligations of the client. And if we go further, you can see that the long-term loans or obligations are added up from the long-term loans and debt. Long-term loans are loans that have to be paid by the client, and they have a longer tenure, like 5 or 10 years. They are typically investment loans, so loans that the client actually borrowed from the money and uses up for actually executing investment projects. Long-term debt in this case refers to the bonds that were actually issued by the company. A little bit later, we'll talk about what is a bond, long-term debt. Basically, this is a credit, long-term credit, that are often linked to investment execution, and corporations tend to actually issue it when they need capital from different and very different and wide range of sources. And it's a tradable credit instrument, so you can, or the investors can, buy or sell it and making financial return and income on that. And now if we add up the key parameters, then you can see that we had adding the equity, the liabilities, and the accurate expense. then we can get a huge number. And obviously, in the next years, even higher, 370. Obviously, here we had a long-term obligation change, which means that the company issued a substantial amount of debt concerning to the first year. So this was the most substantial change regarding the balance sheet. Obviously, on the equity side, there were no big changes. So the company in the last year indebted itself substantially